Pepsi, ticker symbol PEP, is down 4% this year. In this video, we're going to be looking at their most recent earnings, their financials, their dividend, and we're going to do a discounted cash flow analysis. For those that don't know, Pepsi operates in the food and beverage industry. They have some of the most recognizable brand names in the world. These include Pepsi, Lay's, Mountain Dew, Gatorade, Doritos, and many more. Pepsi is also a dividend king. As you can see, they have 51 consecutive years of increasing their dividend. They have a market cap of $234 billion, a dividend yield of 2.97%, and a forward-looking PE ratio of 20%. Looking at Pepsi's most recent earnings, you can see from this headline that their earnings topped estimates, but the quarterly revenue slid for the first time in nearly 4 years. They reported earnings per share of $1.78 compared to $1.72 expected, but their revenue was $27.8 billion compared to the $28.4 billion that was expected. They reported a net income of $1.3 billion, which is up from the $518 million from the year earlier. The net sales dropped less than 1% to $27.8 billion. It's the first quarter since 2020 that the company's quarterly revenue has declined compared with the year-ago period. Pepsi's organic revenue grew 4.5% in the quarter, which was helped by the higher prices, but those same prices also hurt the demand for the food as they've gotten more expensive. On a more positive note, Pepsi announced an annualized dividend raise of about 7%. This raises their total payout to $5.42 per share per year. Looking at Pepsi's revenue, you can see the revenue is growing, and it did have a couple down years from 2015 to 2018, but overall it is growing. Their revenue in 2013 was $66 billion, and the revenue in 2022 was $86 billion. There is a 3-year compound annual growth rate of 9% and a 5-year compound annual growth rate of 6%. While this compound annual growth rate is a little slow, this makes sense as Pepsi is a very mature company. Looking at Pepsi's net income, you can see their net income also looks pretty good, as in 2014 they made $6.7 billion in net income, and in 2022 they made $8.9 billion. You can see this one year in 2018 they made $12.5 billion in net income, and that was because of a $3.4 billion tax benefit. So that's just a one-off year. Looking at their CAGR, they have a 3-year CAGR of 7% and a 5-year CAGR of 13%. The 13-year is skewed once again because of the 2018, but overall they are growing their net income at around 7% a year. Taking a look at Pepsi's free cash flow, their free cash flow is all over the place. In 2014, they had $6.9 billion of free cash flow, and in 2022, they had only $5.6 billion. Overall, their free cash flow is pretty stable. They are still making a lot of money, but it's not really going up at the moment. They have a 1% 3-year CAGR and a negative 5% 5-year CAGR. Looking at Pepsi's dividend, you can see an incredible growth streak. As you can see looking down here, you can see they've been growing their dividend for the past 51 years. Meaning every year for the past 51 years, they've increased their dividend. This makes them a dividend king. In the past 5 years, they've been growing their dividend at about 7% per year. As we saw with the most recent earnings, they continued that. And in the past 20 years, they've been growing it at around 11% per year. And looking at the dividend safety, you see the payout ratio is 65%. This is quite good, and they say it's on the lower end for consumer staples, which means there is room for them to continue growing the dividend in the future. And the forward payout ratio is 67%, which is slightly higher but is not a problem at all. One of the reasons why Pepsi is down is because their products have gotten more expensive. As their products have gotten more expensive, companies have taken them off the shelves. As you see this headline, PepsiCo products were moved from supermarket giant shelves over unacceptable price hikes. On average, they increased the prices by 9%. So as more stores take away Pepsi's products, it decreases their sales and it makes it harder to reach their sales goals. And using a discounted cash flow model, we'll predict for the next 5 years using a 7% discount rate and a 2% terminal growth rate. If you put these in a discounted cash flow model, you see you get a base case of $182 per share, which would mean that it's undervalued by 7%. Looking at what we'd expect from the revenue growth, if revenue grows at 5%, this would mean that the company is undervalued. And obviously, the higher growth it has, the more undervalued it is. But as long as Pepsi grows their revenue by over 5%, they are considered an undervalued company.